Let's start with a truth that rarely gets said out loud. Most investing advice today is just noise. It's fast, twitchy, trend chasing stuff. 1 minute it's all about AI stocks, and next it's gold, then back to crypto. It's clickbait dressed up as wisdom, and honestly, it's kind of exhausting. But there's a different kind of guidance out there, the kind that doesn't shout it. It whispers. It doesn't trend. It endures. It comes from people who've actually built wealth, lost it, learned from it, and spent their lives helping others do the same. That's what this video is about. I want to walk you through 6 timeless investing principles. 5 come from names you're probably going to recognize, icons like Buffett and Bogle, and the 6th from a legend in the business, Darryl Rosen. Obviously, I'm not a household name unless you count my own household. But the 6th lesson is the most important I've ever learned. And calling it a hard lesson doesn't even begin to cover it. It's the kind of lesson that leaves a mark and in the end reshapes how you see everything. So let's kick things off with the man who practically is investing wisdom after I quickly introduce myself. Welcome to the Retirement Guy channel. I'm Darryl Rosen. In my role at SECURiMENT Wealth, I help people like you plan for and hopefully enjoy retirement. Hopefully. Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. And these words are famous for a reason, because they hit a nerve, because what he's really saying is don't follow the herd, especially when the herd is panicking or partying. When markets are climbing, people get greedy. They chase returns. They overinvest. They forget risk exists. We saw it in the late 90s with tech stocks. We saw it again in 2021 with meme stocks and crypto. Ends up the same way with fear. Fear sets in when markets tumble. People sell low. They go to cash. They swear off investing entirely until the next boom. So Buffett's advice flips that script. And in fact, I have a client, we'll call him Paul. He retired in 2020. Yes, that 2020. On paper, he certainly had enough to retire, but then came the COVID crash. Stocks dropped more than 30%. Paul was ready to sell everything and wait for things to settle. So we met. We sat 12 feet apart to be safe. And I begged him not to because he had a plan in place. Buckets, cash reserves, guardrails. He didn't need to touch his stocks for 2 years. So we didn't. And guess what? He came out way ahead because he didn't lock in those losses. That's Buffett's lesson. When the market is on fire with hype, pause. When it's falling apart, stay calm or even look for opportunities, because investing isn't about guessing right. It's about behaving right. John Bogle said, don't look for the needle in the haystack. Just buy the haystack. He gave the investing world a gift. Simplicity. He created the first index fund because he believed most people didn't need more complexity in their lives. They needed consistency. And here's the thing, the data backs him up. Most actively managed funds don't beat the market over time. In fact, a SPIVA study shows that over 80% of them underperformed their benchmarks across a 10-year span. So Bogle said, why not own the whole thing? Why not stop trying to guess and just go with the odds? A client once, Linda, who was in her late 60s with 5 brokerage accounts and 47 different holdings. She was proud to be diversified. But when we dug in, she owned 3 different funds that held the same top 10 stocks. She was paying higher fees and creating more stress for no added benefit. So we simplified her portfolio into 3 core index funds: US, total market, international, and some bonds. Suddenly, her statements were clearer, her taxes were easier, her anxiety went down. That's Bogle's legacy: less stress, lower fees, and better odds. Index funds don't make the headlines, but they make retirements work. Bogle didn't promise you'd beat the market, just that you'd stop losing to it. And in retirement, that's often the smarter game to play. Peter Lynch said, know what you own and know why you own it. He wasn't afraid of picking individual stocks, but he was allergic to people doing it blindly. He ran Fidelity's Magellan Fund from 77 to 1990 and averaged nearly 29% per year. That's not a typo. But Lynch never encouraged investors to chase performance. His mantra was simple: invest in what you understand. And that's where most people go sideways today. They don't understand what they're buying. They hear about a hot stock on CNBC, their neighbor mentions some tech company that just doubled, Nvidia, anyone? Or they see a chart trending on social media and decide they don't want to miss out on that explosive growth. But here's the thing, Lynch understood that most people forget. And by the time you hear about the big winner, it's often already had its run. The big move, it already happened. And there's a lot of research behind this. Multiple studies show that investors tend to pile into funds or stocks after periods of strong performance. They buy high and they expect the trend to continue, but these hot streaks, they rarely last. And Morningstar has even coined a term for this. They call it the behavior gap. It's a difference between what the investment earned and what the average investor actually got because they mistimed their entries and exits. It's a classic case of buying yesterday's success and hoping it repeats tomorrow. I remember sitting down with a couple who had 15% of the retirement portfolio in a leveraged oil ETF. When I asked them why, they shrugged and said, "It's done well lately." That was it. No understanding of how it worked, no awareness that it reset daily, magnified both gains and losses, and it was wildly volatile. They weren't investing, they were guessing. Lynch wouldn't have scolded them, but he might have said, "That's not investing, that's speculation dressed up in a nice suit." Okay, he didn't say that, I'm saying that, but I think he would agree. The truth is, most retirees don't need moonshots. They need reliability, clarity, sleep at night money. And that starts with knowing what you own and why you own it. So here's the real takeaway. If you can't explain a holding to a friend over coffee at Starbucks in under 30 seconds, it might not belong in your plan. Understanding beats excitement, especially in retirement. The late Charlie Munger, Buffett's longtime partner, he said the big money is not in the buying or the selling, but in the waiting. Munger had a gift for saying complex truths in plain English, and this one might be my favorite. The reason is because it calls us something we all struggle with: impatience. Most investors don't lose money because they choose bad investments. They lose money because they don't stick with the good ones long enough. They get bored or anxious, distracted, so they sell low. They jump ship too early, or they move their money every time the news gets scary. Munger called this behavior suboptimal. I call it expensive. And I remember a retiree named Doug who came in frustrated. His portfolio had barely grown over the past 18 months. He was ready to sell his entire US equity position and move to gold and energy. Those are doing well, he said. So we went back and we looked at 20 years of returns. The US equities had outperformed every asset class over that time. He just hadn't held them long enough to see the payoff. That's what Munger meant. The market rewards the patient. The biggest gains often come in short, unpredictable bursts. If you miss those bursts, your returns suffer. So Munger's advice is not sexy. It won't land on a crypto Reddit thread, but it works. Wait. Let time do the heavy lifting. Benjamin Graham said the investor's worst enemy is himself. He's often called the father of value investing. He mentored Warren Buffett. He wrote The Intelligent Investor, which remains a must-read almost a century later. And this quote of his, it's hauntingly true. The investor's chief problem and even his worst enemy is likely to be himself. We like to think we're rational, that we make decisions based on facts and logic. But the truth is we're emotional creatures. We chase gains, we fear losses, we act on instinct, and often at exactly the wrong moment. Graham believed the hardest part of investing wasn't the math, it was the psychology of it all. I saw this up close in 2020 when COVID hit and the market tanked. My phone lit up, not with questions, with panic. Should we sell everything? Should we wait to get back in? Is this the end of the economy as we know it? The hardest calls I had were the ones where I had to talk someone off the ledge, out of acting. Sometimes the best move is no move at all. And that's why Graham's message is still so powerful. It forces us to be self-aware, to recognize that our instincts, while we're human and are human, can be harmful to investing. The solution: create guardrails, use systems, set up auto investments, build portfolios that don't need daily decisions. Because if you remove the need to act emotionally, you give yourself a chance to win. And the last expert is Darryl Rosen. Never take risk with money you need to pay your bills. This one's personal, and it's not from a legendary investor, it's from me. But it's the hardest financial lesson I've ever learned, and it changed everything about how I approach investing today. Back in 2008, I had just sold our family business. I wasn't sitting on $1 billion windfall, certainly, but I had a decent nest egg, enough to feel optimistic. And the plan was to start a new venture, something that I would find some meaning in. But I made a crucial mistake. I rushed to invest that money before I fully understood what my life and my spending really looked like. At the time, we had 3 young sons, expenses were high, and I hadn't yet rebuilt any income stream to replace what I'd walked away from. And all of that didn't stop me from charging ahead and investing as if everything would go smoothly. And then came the 2008 crash. During that stretch, I found myself doing 2 things: selling and spending. Selling investments to cover life, spending money because I still hadn't adjusted to the new reality. And the problem is, once you sell from weakness, once that money is gone, it doesn't come back. That's not market volatility, that's permanent damage. It was supposed to be an exciting chapter in my life, new freedom, new opportunities, but instead I spent those months feeling anxious, overwhelmed, and frankly, ashamed of what was happening. It was a dark time for me, but it also led me here, to this profession, to this mission, to helping people avoid the exact mistakes I made. And that experience gave me a rule I now live by, and one I pass along to every client I meet. Never take risk with money you need to pay your bills. That's why I'm such a strong believer in planning around time horizons, not just asset allocation. Because when the market drops, you need to know which dollars you can afford to leave untouched and which ones you can't. Here's what that looks like in simple terms. A year or two of cash or short-term bonds to cover near-term expenses. For 3 to 10 years out, more conservative investments to provide some stability. And then 10 plus years, money you're not gonna need for a long time in growth assets like stocks. Money you don't need right away. And I think of my client Judy in 2022 when the market dropped. She didn't touch a single stock. And the reason is because we had set aside a full year of living expenses in high yield savings accounts, even if rates were a little bit lower. And that buffer zone let her ride out the storm without selling anything at a loss. And that peace of mind is priceless. This is known as sequence risk, and it isn't just a theory. I lived it. And I also survived it because I rebuilt, rethought, and now help others prepare and advance. And if you take nothing else from this video, please take this. Protect the money that keeps the lights on. Let the rest grow on its own timeline. This one shift could change your whole retirement. It certainly has had a great effect in my life. So let's summarize a little bit. Your plan is the hero. Buffett says stay calm when others aren't. Bogle says simplicity wins. Lynch says understand what you own. Charlie Munger, he says patience pays. And Alexander Graham said master yourself. And Darryl Rosen, never take risk with money. You need to pay your bills. Notice nobody's saying find the hottest stock or to time the market perfectly. That's not what good investing is about, especially in retirement. Good investing is slow, it's steady, it's honest, it's having a plan that you can stick to, not a bet you're hoping works out. And if you don't have that kind of plan and you're wondering if yours will hold up when the world gets loud, that's what I help people figure out every day through a SECURiMENT review. We pressure test your retirement for flexibility, taxes, market dips, and real life, because your portfolio shouldn't depend on luck, it should depend on wisdom. So let's build something that holds up. If you like this video, you might like this one. And as always, thank you for watching.